Hello traders, Gary Wagner here, just about 10 minutes after 10 o'clock in Honolulu, 10 minutes after 4 in New York. It is Monday, March the 20th, 2017, and this is the Daily Report for Gold and Silver. Continuing the dynamic rally that began on Wednesday of last week. Immediately following the conclusion of the FOMC meeting, we have gold trading higher, although today nominally higher on the day, but higher nonetheless. This is most active April futures at $12.34, putting it up about $3.80. Now, we did send out a special trade alert, and that's for June gold. I'll touch on that in 1 second. Spot gold currently trading at the same price, $12.34, but up about $5.50. And lastly, want to take a look at June gold, because we would have the April gold expiring towards the end of March, first notice day, I mean. And so for that reason, my recommendation was to actually put your position on the June futures. The symbol for that is GCM7, M standing for June. That's currently trading at $12.3730, up about $4.10, but $37.40. When we compare that to April, I'll move back to that. You can see there's about a $3 spread between April and June futures. We'll touch on that throughout the show as we go over our current trade. Silver also trading higher on the day. Net change in gold was about 0.33%, not so much in silver, up just over 0.1% at 1743. The low on the day has been 36, and the high has been 47.5. So traders, we did put out a special trade alert this morning recommending that our subscribers initiate long positions in the market. We'll talk about that in terms of specifics in a second as we pull up a June chart, but we will be using the most active, of course. Most active eventually will convert over to June, but right now it's representing April futures at $12.3380. Remember, there's about a $3 spread between June and April futures. But here's the key, and here's why we actually sent out that recommendation this morning. As you know, ever since we had the dramatic rise with the Fed meeting last Wednesday, that's this candle here, although as I talked about a little bit on Friday, it really shouldn't be like that. I'm not convinced as to why that is, because I didn't see the market really sell off that hard going into the close where it gave up this much room. But nonetheless, this is what we're showing as the chart, but I'll draw that in. But ever since we had this dynamic surge, I was hoping for some kind of a dip to come into the market. Typically, when you get those dramatic $17, $20 rises, you will get, $5 or $6 coming back for the short-term traders pulling profit. We did not see that. Here is Thursday's trading activity. This small candle here is Friday, and of course, this being today. Now, if you notice on the left-hand side, I've got our basic fib retracement, and this is the long retracement from 1120 all the way up to 1265. And the key is that the 23% retracement level from this retracement comes in roughly at about 1231. So once the market had dynamically broken above that price point, my sense was that we might not get the kind of correction or kind of softening that I'd hoped for to enter at a better price. And I certainly didn't want to be priced out of this trade, because my initial target on this trade has got to be about 1265. 1265, of course, is the highest that gold has traded to this year. This is our yearly high here, and this is the culmination of a two-part rally that began middle of December. First leg taking it up, to about 1220, then back down to 1180, and then to 1265. So I believe that this, if the market continues to rise, and I am anticipating a continuation in the rise, if in fact that's what we see, I would expect there to be some resistance at 1265. So that is our initial exit strategy or target for this current trade. So traders, I've just pulled up our daily chart, this of our June contract, June futures in COMEX Gold, 1237, 1237.10. That's roughly where it's trading at, and this is the area that we got in. I also recommended placing stops just below either 1219 or 1220. I'm not sure. I'll have to look at my notes to see exactly where it was. But the rationale behind that is the fact that it puts us below the lows that were achieved on this particular candle, which is the day following the Federal Reserve. This would have been Thursday of last week. If we move over, we can also see that this particular area was a supportive area right in here. And so I believe that that is a pretty important number. Behind that, of course, is going to be 1214. 1267 is the high in terms of June. And as I said, there's roughly a $3 spread between June and April futures. And I did recommend that we get into June. My recommendation is therefore obviously to maintain your current long position and to maintain your current stop. Interestingly enough, US dollar is actually slightly higher on the day. So it's had a negative impact on gold, unlike what we saw last week, where the big dramatic rises in gold had a significant portion of that due to a weakening US dollar. We've got a nominally unchanged dollar, let's call it, at 100.32. The low on the day has been 02 with a high of 145. Over to U.S. equities, mixed bag with the Dow Jones Industrial Average and the Standard & Poor's closing slightly lower to, in essence, unchanged. Dow Jones really parring some of the earlier losses of the day, closing at 20,905. Standard & Poor's also trading just a little bit lower, 0.17%, as you can see, 4 points at 2375. And the dove outside of all of that today has been the NASDAQ. NASDAQ, in essence, unchanged, but slightly higher. Realize that we are closing up near contract and historical record highs in the NASDAQ at 59.01. And then lastly, crude oil continues a drop in the market, although today it's not as significant, but it is down 8%, 48.23, down 55 cents a barrel. A net change of 1.1% in terms of the drawdown on the day. Dollar under some dramatic pressure last week. This, of course, is a weekly chart, standard bar chart format. You can see these red candles here, not so much 2 weeks ago, but last week. This, of course, is last week when the Fed did raise rates, however, had a much more dovish stance than originally perceived. We can see that it came down quite a bit. I believe about 1.5% is what the drawdown is. And now we are sitting right at this 28-week moving average. Also notice that we have our channel lines here. There's no doubt there has been a bias to the upside when we look at the long-term dollar. But then when we look at recent activity, we can see that the market hit these highs back in, October of last year. Again, a weekly chart. Declined down to about 99, came back up to 102, and now is moving back down. My sense is that at least we will see the dollar continue to show some weakness, and if it does show weakness, I would expect it to at least go to the bottom of this channel, which comes in roughly at 98.5 to 99. And traders, the next chart that I do want to look at is a chart of crude oil. Crude oil dropping again today, down about 1.2%, a drop of about 60 cents per barrel at 48.19. We can see that last week we had a slightly higher close, although we had some pretty dramatic highs and lows, low being below the channel line. And then, of course, this high coming in still below 50, but I believe it might have touched around 49, that being at the beginning of the week. Of course, this only being Monday, but we are right at the bottom of this channel line. Now, although there is a slightly bullish bias on this channel line, the predominant factor in crude oil has been this sideways market that has been so prevalent, this being November of last year here, December right in here. So really since the beginning of 2017, 2017, actually maybe mid-December of last year, we can see that the characteristics in crude oil pricing has been that it was steady, and it was steady trading between really 50, 52 on the low and 54, maybe 55 on the high. We certainly broke hard below that a couple of weeks ago. We had some stability last week, and now we're looking at the potential of it breaking below this particular price point. If crude oil does break below this current price point, which sits at around $48 per barrel, the real next level of major support in the market does not come until about 40. There is some minor support at around 42. You can see these lows in here and here. Again, this being a weekly chart. So I would look at 42 and 40. If we have a break below this particular area and the market is trading at 48 per barrel, I think we could see crude oil go as low as $40 to $42 per barrel. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.